let us start. So for those who don't know me, I'm a business intelligence analyst working at Google for the last 10 years. I have 2 degrees, computer science and finance and data analytics. I founded pythoninvest.com project about 3 years ago, and this is our first training course in a partnership with Data Talks Club. And I'm also a retail investor. Today we will cover these items. We will first start from the questions that you asked on Slido and some comments from the home assignment. I'm reading them all, so please leave your comments if you have something to say. Second, we'll talk about system design view. What are we going to achieve today, and how does it fit to overall system production? And the main thing is for today is to create a unified dataset, a flat table if you want, that contains inputs from several data sources and daily stats that can be used for the next steps for modeling, testing strategies, and automation. And of course, to create this, we will talk about many technical problems such as joins and primary keys, how to perform data validation during joins, how to do data cleaning, and how to read and transform the data to the proper types. We will work in Pandas, so all our code is shared, and it is done through Python and Pandas library. We will occasionally see visualization examples using libraries Matplotlib, Seaborn, and Plotly Express. We will describe in detail how to transform data types, how to do data cleaning, and how to enhance dataset for next steps, how to generate new features, which features are the most important ones, such as historical returns, future returns, and then we will spend some time on discussing technical indicators. This is derived set of features from our main data source of daily stats. And during the whole module, we will see the examples of a descriptive analysis. So what system do we try to build? We talked last time about data sources. Today we will have mostly the same data sources. I will introduce just one new database, and as an output from the previous lesson, you should learn how to retrieve data from those data sources. And if you want to build the whole production system, and the output from the module 1 will be a set of files or a set of tables that are separate, that are not connected with each other. And all these data tables we upload to Pandas, and we connect them into one data frame, which is aimed to be updated every day. So the output of today's module will be one large Pandas data frame, and if you check the collab, there is a file export in the end of the collab. As usual, please join slido.com, add hashtag SMAZ to ask your questions and vote for them. But for now, let's discuss previous questions that I saw were asked on the last week. Question number 1. Is it doable to have a full-time job and getting started on the investment train? What kind of time investment are we talking about in ballpark numbers? It highly depends on analytical, financial, math, and programming knowledge that you have. And as you can see here from my brief analysis of your homework submissions, the average time that people spend on lectures is between 2 and 4 hours, and sometimes there were cases of spending 30 hours just for lectures. For homework, on average, you spend 5.3 hours, but I trust more the confidence interval 25, 50, and 75%, and this confidence interval is about 2.5 to 6 hours in 1.5 weeks. We will try to provide more time for you to solve the home assignment. We will make sure that there are at least 2 weekends included, so you should have plenty of time to solve all the problems that you need. And more than that, I will try to include less problems this week and see if you can solve them faster. Please submit these numbers, because I see that approximately 30-40% of people didn't submit those numbers, and I can't understand how much time did they spend on it. So next question, will the course provide a starting boilerplate code to begin with, an initial strategy that we can tweak and build upon over time? Yes, as a result of each module, you have a collab with the codes, and you can copy and run it straight away. It should work, and it has the boilerplate code and the data, and it should be enough to start with any strategy. How much data is enough? 1, 2 years, 10 years for comprehensive data analysis? This is a hard question, because the general answer is get as much data as you can. The realistic answer is that you need to check that most of the features that are important to you are filled in. You need to make sure that the data is correct, it is updated, and it is reliable. And you need to make sure that data transformation doesn't take long hours if you plan to update it every day. So I will use 25 years of daily data, and today we will have 33 stocks with 25 years of daily data. Next question, is there a way to add fundamental analysis to this collab? So I will show how you can retrieve fundamental indicators. It's only 4 years of yearly stats from free data sources. I couldn't find a good reliable data source for a longer history. And that's why I won't use it in my result in DataFrame. But if some of you can provide a solution and can find how to get all those data on ratios, you're more than welcome to use it, and please share in Slack. Question number 5. May I ask some coding styles and usages for homework one after due day? I don't fully understand the question. Could you please ask this in Slack? You should be able to see the score and the leaderboard. I don't plan to share the full solution. So this is the public link. I didn't submit any results, but I graded the homework, and you can see there the right answers. What I suggest for you is to ask this question on Slido, and if there are enough votes and if anyone wants to record their solution, I will be very pleased to see that. Right now I'm slightly slow on producing content and creating you next homework, so I won't do this. What are the latest research topics about the machine learning used in stock market? So research is not covered in this course. If you know about something interesting, if you could replicate, and feel free to use it for the projects and share with everyone. In my opinion, and in my limited experience, oftentimes it is hard to reproduce the research, the code is not shared, and the value is questionable. So you might end up spending 1 month in trying to reproduce some research paper, and you won't see great results in terms of model accuracy improvement or profits improvement. Or you will. Let us know. Selected comments from home assignment. First, there were a bunch of comments about problems with open-ended questions, question 6 and question 7. So that was intentionally, that I didn't ask straightforward questions, but I asked open-ended questions so that you can experiment, you can suggest new ideas, you can think, you can read, and the overall idea is that there are no wrong answers, but please don't submit some random set of words. So if you don't have time or you don't have anything to say, just leave it empty. If you don't understand the question, ask for clarification in Slack. And you're expected to read additional materials on the topic, because we can't cover everything in detail. Next comment, Pandas data reader seems not updated anymore since a while. I would suggest using other libraries to gather data. I use it all the time. It seems that data from Fred that I'm using, that I'm retrieving through this library is updated daily. I don't see big problems with this library, but if you have a better solution, let us know. It would be helpful to devote 15 minutes of the week 1 lecture to working with the time series data in Pandas. So I added a link here, and there are slides today about time series methods. Next comment. It's odd that some loading data from ticker and tickers methods have incomplete data set. So then, just because I don't have much proficiency in using Pandas, I finished this homework somehow longer than I expected. And last, I can't find an efficient method to set the timestamps. I think that's the downside of using free data sources. Sometimes not all methods are implemented, and you have to live with this, find the alternatives, or buy some paid data if it's not too expensive. With the timestamps, I'm not a power user here as well. So my recommendation would be, don't rely on the exact dates, but use shift functions back or forward for some number of days, and calculate relative metrics using these shift functions. Next comment, I'm quite new to programming last June, so this is still hard, but I enjoy it very much. So there were similar comments that the level of material is quite hard. You spent a lot of time on this. Please continue doing this. We won't introduce a lot of complexity in the next few modules, but don't expect it to be easier than Module 1. These comments, number 6, is about open-ended questions that you don't know what additionally can be submitted, and what additional data can we look for. So I have several answers for this. First thing that this course is, we run it for the first time, so please help us to shape it and show us the mistakes that you spot. We will try to fix it. Next thing is that I don't expect that you answer all the problems. So if you don't know or you don't have time, feel free to skip. And last but not least, the breadth of the materials is quite big. So we're trying to cover different aspects of investing, different time series, markets, instruments. It may be hard to understand all of that, and you don't need to know about every single time series on the market. We will focus on a standardized data set. We will provide it, but please keep experimenting. Please add more indicators and try to adjust for your needs. And there are some selected text answers from homework that I want to share. I made the repository of my homework private, but I have invited Alexei so that he can view the homeworks. I'm the only one who reads your submissions, so if you provide links, and especially if you provide links to the private homeworks, I won't go and check those. You can trick the system, but you can't trick yourself. Same links not working or nothing there. Sometimes the links are like this, http notapplicable.com, or people submit just their GitHub main repository and enter point and nothing there. So you better don't submit anything if there is no solution. Again, see homework URL explained in the collab sheet. If you see the text question, and I expect that you fill in text answer. Or I have no idea by now, I'm afraid to have no good answer. I would better leave empty in this case. Sometimes there are some totally irrelevant things like this, or what is even worse, ChatGPT generated and generic content. Hopefully you can all improve and submit perfect home assignments for the next time. Now let's begin. What we will cover today. So we will start from the processing data that you get from the web page. Then we will talk about our main data set of a daily OHLCV time series from Yahoo Finance. Then I'll introduce new time series on macro, and we will add to the previous ones covered during the previous module to combine into the one data sets to be joined later to the daily stats. I also cover a new data set on the European Union data, and we'll finish with fundamental ratios. First, in initial public offerings. The idea here is that when you scrape the data from the internet, and I use pt.read_html, you will get a data frame like this. The types are not defined, and this is not the best solution for us. So we want to check that all data types are of a specific well-known types, and we want to add additional checks on the quality of the data. So we will try to convert all of these types to some standard types. As you can see here in the code snippet, we convert date to date time, and we converted 3 columns to float. Then we will discuss how to find nulls, what do you want to do when you don't see any data, how you want to backfill, how you want to drop this data, or you want to leave the data as is. We will define new columns, and we will define functions to be applied to the existing columns to produce new columns. Okay, let's move on to code snippet 1. So I ran it just today. If you check the link on GitHub and open it with Colab, connect and run all, you should be able to see about the same data. So what do we do here? We get data on IPO stats. There is a link. If you open this link, it's all 2023 IPOs. Actually, there are 200 IPOs with this endpoint, and maybe it is better to download all of them from this endpoint. But if you want to have a longer history for 5-6 years, you would have to click on different links, download, and concatenate the data. That's what we are doing here. We get the data in HTML. We read it with the Pandas methods. We get this IPO 2023. Then we download another data frame with IPOs from 2024 and stack those data frames. So this is quite a useful technique if you're an analyst. This is a well-known operation, union all. So if you have two tables of the same structure, of the same data types, you can just stack one after another. And we will use it later for stacking data on 33 stocks. So now we have a combined data frame of 213 entries. What do we want to do next? We start to convert field by field to the known types. And first thing is IPO date. We convert to data time. Then I actually found that some of the numerical values are not fields, and there are some nonce, and this is how you can check in this particular case that if you find some string representation like this, it's a bad data, and you need to replace it with something. And if you want to build a reliable data processing source, you can specify this parameter errors equal to coerce, and it will work regardless. But you have a risk of not flagging that the data source is not ideal. So we convert in the same manner all numerical columns to float numbers. And when you have the data frame like this, you can do standard operations with this. Before that, it's a useful thing to do is to check whether you have nulls in your data frame. Is null.sum, or you can see it from here, non-null columns, and to check what's there, and if you want to leave it. So for our case, if it's an IPO data and we want to analyze it and we want to have an up-to-date data, we better leave it and track from Yahoo Finance if we can retrieve a daily data on this new ticker to be appeared there. But for everyone, for all other stats which are not none, you can calculate some stats like average IPO price, that's $10.8. You can do the descriptive analysis with one function called .describe, and from here you can see that IPO price on average was $10.8, median is 7.5, and 75% quantile is between $4 and $12.6. What is important for us is to look at the return. So if we blindly invest into most or all of the IPOs, what is our expected return? And you can see from here that median investor will actually have a negative returns, which is not a very good sign. But if you're in the top 25% quantile, you will get 5% of returns. You can visualize some of the stats, and here I show an example of using Plotly Express. The difference of this type of visualization versus many other easier visualizations with Matplotlib is that you can zoom in, you can double click, you can have additional information just saved in the collab. And I will ask you in homework to design a simple investing strategy around new IPOs. For example, if you check the recent Reddit IPO prices, they went public about 1 month ago. And on the first day, their price was about $45, and then there was a spike to $65, and then for a few days it was higher than $45, and in about 1 week it's moved to $45, and now it's going down. The question for you will be, let's assume that we invest for a fixed number of days to all new IPOs, and can we find this ideal or optimal number of X when the expected investment return is positive and more than 0 and is maximum? So like a blind strategy that we invest for 3 days or for 5 days, or we can't find such X when we have an expected profitable strategy. As you can see, it's a pure analytical problem. It's there is no machine learning or additional features. You just look at the time series of similar investments. You define on the previous data some optimal strategy, and you try to apply it for the future dates. Okay, let's move on. Next thing is time series data type. I can't say that I'm an expert here, and I occasionally use specific functions for time series. What I can say about these fields, that oftentimes I use pd2_datetime function to convert string to data time. There are many date-related functions, like you can read the year, the weekday, months, or generate time deltas between different values easily. Then you can also use functions like front fill or back fill or interpolate if you don't have stats that are filled. So that's quite useful, and you will see later when we merge the data and when we don't have the latest data available, we will use the value that we saw recently. You can use error handling parameters for dealing with Pandas transformations for time series or for other objects. That's regardless of time series time. And indexing, I've read actually in the docs that if you make a time series as a date index, it provides a lot of caching, and it should work faster. Code snippet number 2. So we use time series. We use all daily history for one ticker NVO. This is a European company. It has a history from 1981. The Pandas DataFrame looks like this. The big benefit of using API is that you don't need to think about the data quality and types. Usually, that you can see that datetime index is created by default, and all numerical types are not object, but actually they are float or integer. I filtered the data frame to represent only last 5 years, and you can see the visual graph. I create new columns in the data frame. So I create year, month, week, date, and date. I use this date column later for joining with all other time series. The reason why I created exactly the same column as you can see in this index is that this index is not enough if you have many tickers downloaded and stacked one under another. So if I have 33 tickers here, the real index is 2 columns, ticker and date. So you need to redefine index. So next, and I use this approach sometimes for debugging, I create shifted values. So for example, we have one time series. Pandas understands that we have datetime index, and we see, we look at the adjusted close number, 128 for 23rd of April. If we shift it back, actually we will see here the value that appeared tomorrow but shifted back for today. And if you shift it front, you will see some value that used to be yesterday, but now it appeared for today. If you have these values, you can easily divide one on another and calculate historical growth or future growth. So historical growth for the last 1 year, it's adjusted close for today divided on adjusted close shifted. So that's 128 and divided on 125. So as you can see, yesterday it was 125. We had a small growth, and the number of a growth should be slightly more than 1. It is maybe 3% per day. The same idea is to generate growth 30 days ago, 3 days, 7 days, 365 days. There are no exact recommendations what you need to have there. More data you have generally is better, but the dataset becomes too heavy and too complex. Next idea is you can generate future growth in 1 day, and that's what we want to predict. So let's assume we want to invest on April 23rd, and we have all data before this date, but we want to predict what will happen in the future, and on the historical data we can actually do this. So we can divide the value 126 on 128, and the future growth is actually negative, and that's how we generate future growth. This is an absolute number of growth, and it is it can be used for regression models. We also generate one binary model, which is called is positive growth 1 day future. So it is defined as 1 if growth is more than 0 and 0 if it is less than 0. Okay, let's move on. Today we will introduce more macro indicators, and actually I saw that many of you already wanted to see these indicators, so please continue sharing your thoughts. First thing is VIX. It's a volatility index. Why we are including it? Oftentimes it is a well-known fact that when it's more volatility, then some trading strategies like arbitrage or daily trading strategies, they have more opportunities to win, because the changes there are so many changes in prices. So overall market volatility, and especially comparing this volatility versus your stock volatility, can add additional knowledge for models to predict what will happen in the future. Then I add 3 more asset classes. Here it's gold, Brent, and crude oil, and Bitcoin. So you can add even more than that. You can see that the time series are quite different for all of these classes. And the main hypothesis is that we live in the complicated and interconnected world, and there is one demand. And sometimes when it's a recession coming, people will go to invest into gold or some safe assets. When Bitcoin is growing, there will be more demand into Bitcoin and crypto, etc., etc. So you can't live only in stocks or in crypto world. You need to add some other benchmarks to compare with. The code snippet for this is quite similar. We use the same function to download data from Yahoo Finance. We just specify different ticker names. What is different this time? That I calculate growth numbers in a similar fashion that I showed you just 10 minutes ago. Growth numbers for 1, 3, 7, 30, 90, and 365 periods ago. It's not days, and as you can see here, this is the first date when we have data on DAX index, and growth 1 day ago is not defined, and that's expectable. But on the next day we can already say that just at close number is lower than it used to be, and growth is less than 1. So these numbers are quite important for us, because there are many cases when indexes or stocks or other financial instruments, they are growing all the time, and it's better for the model to provide the data that is stationary, that is not growing indefinitely. Okay, I think I forgot to mention that I defined a function for this, get growth data frame. So it has an input as a data frame. It generates the same columns, and it's filtering the data frame to remove the original absolute numbers. So that's when we join these data sets, DAX daily to merge, it has only growth stats. And the same thing is for S&P 500. We generate growth for S&P 500, and Dow Jones, India ETF, stats, and some other indicators. In this case, for Module 1 data, GDP growth, which is a quarterly data, and CPI, which is a monthly data, we provide growth stats as well, but you need to remember that the data is quarterly or monthly, so that you do a proper joins with a daily data set, that the same data is propagated throughout the whole period before the next data is available. Let's go on. This is a new data set from European Union. It is quite similar to what we discussed last time about Fed prices or US government interest rate curve. This is an advanced data set, but I want to highlight that if you want to analyze some stocks or some instruments in Europe, especially if they're connected with debt or bond instruments, this is a good data set to have. Let me find it where I have it. So Eurostat. I just changed this in the last two hours. It used to be a long wait time when I wanted to see the all periods available. So as you can see here, I limited it to only 1 month. I had to look into the code definition of this data and understand what input parameters it allows to make it working faster. Now it's working in 10 or 20 seconds, but that's the problem with new APIs, that sometimes they are not very well documented, or slow, or not reliable, or not very convenient here. So this data set, it generates an additional column for every day that you have. I would expect it to be in a normalized way when you have a date and when it is stacked one date under another, and not growing into many more columns. But you have what you have, and you need to work with it and transform in a proper way. Fundamental indicators. As I have said, this is a hard data set for me, because it's nearly impossible to find a free data set or reliably scrape long history of data. If you can find it, please let us know. If you still want to have any data from the fundamental indicators, I would say you go and get the data on earnings dates and EPS estimates, and add some additional indicators that you get from the yearly or quarterly data on revenue, net income, profit margin, earnings before interest, depreciation, amortization, P divided on E, and other ratios. So if you don't know anything about it, I would suggest that you read some book, and I added a link here. I'm not a very advanced traditional ratio analysis analyst, but I see that there are a lot of websites, and someone from Slack actually pointed out to Guru Focus, and it's quite beautiful, and many stats available, easy to digest, highly recommended to read about it. And now let's look into code snippet number 5. So this is only one ticker information. Walmart. I ran it yesterday and it worked fine. I ran it today and earnings date are correct, but EPS are not, and surprise and reported EPS. So even if you get the data from the API, you might want to place additional checkers that the data is good. The thing is that if you get this yearly data, it is not available straight away, and you need to think about when the earnings stats were released. For example, for the yearly data for 2023 data, what you see here, 2024, 31st of January, you try to find a date here when it was released. So it usually happens 1 month after, somewhere between end January and end February, and you can add these numbers or whatever metrics that you generate only after this date when it is actually available, because otherwise you leak future available information to the previous dates, and your model will quickly learn from this and get wrong results. So the code is simple. You get some stats on EPS, on net income. You can visualize and add to the data frame. So now let's move to the next topic, how you can create a unified data set. But before we go to the merging steps of different unrelated or related time series, let's look again at our main daily stats data. Same company, NVO, and you might have seen that oftentimes in financial news or websites there is one type of chart that is shown always. It's called candlestick, and here you can see two types of chart patterns. They are green if during that period there was a growth, and this size of a candlestick actually represents a low, open, close, and high values that happened in that period. And you can see red or bearish candles when some asset actually declined in value. I have a code snippet number 6 where you can produce the same graph. Let me find it. Sorry, I need to scroll. Okay, so it's Plotly. This time it's not Plotly Express, it's just Plotly, and it's a dynamic chart. You can zoom in, you can point a mouse cursor, and you will see additional information. Quite handy, and double click, you will see it back. If you want to design some strategy on this, you can add additional lines, and you ask to explain new fields, and here we will try to explain a simple strategy which is called SMA 10 and 20. I think there are many examples of such pictures on TradingView. They are well known for visualizations and recording some videos from users. you can go and treat more strategies, but for this strategy, what do we have? We have a candlestick chart, and on top of it, there are two lines generated. SMA 10, this is simple moving average, and for every single point, it's actually an average of 10 previous close prices for 10 days or 10 periods that you see here. And SMA 20, the red line, it is an average for 20 previous prices. And you can imagine if the time series starts to grow quickly, SMA 10 will start to react quicker than SMA 20, because SMA 10 has less data and it's more sensitive to the recent data. So it will start to grow faster than the red one. And the idea is to look for the intersections of these lines. So there is some bullish period when everything starts to grow quickly. Green line grows very fast, red line grows slower, but at some point there is a bearish period and green line starts to decline faster than the red one. That's why they intersect. And you want to capture all intersections, and if green line intersects red line from the bottom, it means that it's a beginning of a bullish period and you want to buy. If it intersects again, you want to hold. It's not ideal. It's probably not applicable for all time series if you have a lot of fluctuations going higher and down, but it is something. It is a strategy, and for our time series DataFrame, it will represent only two fields. We will generate SMA 10 and SMA 20. But on top of this, we will generate 200 additional fields that you can use for generating more advanced strategies. So this is our main code snippet for today. This is how you can get the data for 33 stocks. And thanks for someone asking question about India stocks and European Union stocks. This time I decided to combine 3 different markets together, and hopefully we can get a better data set. So, code snippet number 7. The idea is exactly the same as you saw previously. We have 3 different lists, so we combine it to one list, and it's a list of tickers. We downloaded one after another with one function called yahoofinance.download all data. But if we know in advance that we use data only from for 25 years, it's actually a good thing to limit period and show the start date to have to receive less data. We define some additional factors of growth and weekday, months. We also define these what is called technical indicators, simple moving average 10 and SMA 20 with one function call. So it is very fast to do. You can also define some additional metrics. For example, if moving average is growing now, and we define growing moving average Boolean variable 1 if it's SMA 10 is higher than 20 and 0 otherwise, or high minus low or some other factors that you want to generate. So don't think that all factors they are already predefined. If you see something in the graph and you want to model it, just go and try doing it. So we also define volatility for the stock, for a particular stock. This is a 30 days volatility rolling window. So it takes 30 days of adjusted close numbers for one stock. It takes standard deviation for it and multiplies on a square root of 252. This is a number of trading days in a year, and this is a daily number for volatility for a particular stock. And in this case, we define positive growth 5 days in the future. I tried trading 1 day or 3 days in the future, but what worked for me was to define 5 days. That's 1 week ahead, so that I don't have a Monday or Friday seasonality. And when we download all of that, we stack it one under another, and exactly the same way using pd.concat and one DataFrame stocks df, it is expanding with a history prices df of one last stock, and in the end you have a data in one data frame that represents 33 33 tickers. I also define a field, and this is another technique when it's not an easy calculation and you want to create a new field. In this case it's called ticker type, and we want this field to be over 3 values: US, EU and India. I provide those lists of US stocks, European stocks and India stocks, and input it's a current ticker name, and when I see this input I just want to return the type of a stock, and that's how we apply this function to the field called ticker. And here is a function that sends the ticker value into get ticker type function and defines the new column. And you can see here that there are approximately a similar number of records for 3 different markets. So I also highlighted some of the fields which can be used directly in your models without further transformations. Definitely float fields for growth, SMA, volatility, they can be used straight away. It's called numerical features. But for some others like months and weekday and ticker type, we will need to do additional level of transformation, and we will need to generate dummy variables. That's for each value of say ticker type, we will create one column that's of zeros and ones to separate 3 different values of a ticker type. The motivation is that inputs to ML models should be numerical, and you need to generate the flat table that consists only numerical stats, and that's doesn't have any missing values. Some of the ML models, they can handle it, but most of it, they can't. Okay, now we are moving to the next section. I wanted to spend a little bit more time to discuss why do we want to predict the growth rates and why do we want to use features like relative growth rates and not the absolute numbers. As I have said previously, and you can easily check on this graph, say NVO ticker, it was growing approximately all the time. And if you used, if you splitted your data for a train, validation, and test, and you trained your data on 2020 to 2022, your input model, it never saw the data which is higher than 60. But then when you start to predict and when you start to use it for trading, you feed the data which equals to 100 and 120. That means that the behavior of a model can be unpredictable, that you may receive bigger returns, and time series economists or time series models, they never predict absolute numbers. They want to predict either growth or difference between today's value and value 1 week ago, something that is stationary, something that's distributed around one average which is not growing over time. And this slide is about what we are trying to predict. As I showed you, we want to predict future returns. It can be any number of periods. Say if you have an hourly data, you can predict for 1 hour, for 24 hours, for 32 hours. Or in our case, we can predict for 1 day, 5 days, 30 days. I try to select something which is not too short, which is not 1 day because it can be too volatile, but which is not too long as well. If I predict 1 year in advance or 19 days in advance, I might not have enough data to check whether my strategy is working well. Okay. This section is about technical indicators. Roughly speaking, there are 2 types of investors. One cohort, they are actually love technical indicators, some time series generated numbers, and we saw previously SMA 10, SMA 20, and you can get 120 additional fields on this. And others, they prefer analyzing fundamental indicators. You can select either strategy or combine them both. But here I will show you how to generate 120 additional fields using TALib library called snippet 8. I have an article recently published on Python Invest. The code is here. You can see better analysis there, and some descriptive stats and visuals and links. The way how you are doing this, you import TALib library. There are some caveats of importing it properly, and you need to run this code. You can read on Stack Overflow. If you're doing locally on VS Code, you may need to write a bash script or to import it and to run this code once to make it working. but after you do it once, it works forever. So your goal is to import TLib. There is a GitHub project, and there you can see many indicators defined, and you can get these indicators by calling TLib functions. In this case, we have ADX, average directional movement index, and you call .adx function and send data on high, low, close stats for one ticker, and you will get daily results on this ADX indicator. And you can see that there are cycle indicators, momentum, pattern recognition, volatility, volume indicators. All links are here. The way I'm doing it, I define this function that gets all momentum indicators, that calls different functions from TLib, and saves to one data frame. So that's momentum df, and I return momentum df as a result of this function. So I send data on all daily prices for one ticker, and I get all momentum indicators for this one ticker. Same idea for volume, volatility, cycle, and price indicators. I combine it into one function, and there are less endpoints here. And hardest thing is pattern indicators, because there are about 60 of them. There are several books written on it. I don't know much about the most important or most frequent or most correlated indicators, but I treat them as input features and I try to include them all. So that's how we merge these indicators data. We do some additional transformations. It doesn't like when you send integer as an input, so I need to have volume as a float. I need to convert all other series into float type as well. And you can see from here we have 220k records of data, and we will expand this list of features with many technical indicators. We go one by one. For each ticker, I generate momentum indicators, volume indicators, and pattern indicators, and I merge all of them together into one data frame, and then I merge that data frame with initial stock data frame. So what we see here, for example, for one day, this number of records, different tickers, different fields that we had originally, and here you can see a lot of additional columns generated. They are pattern indicators, that's why you see a lot of zeros. They happen not often, but they may be very important. And what I wanted to highlight here, that we were 25 columns and about 40 megabytes of data. Now we are 144 columns and about 190 megabytes of data. So our data is growing quickly. And sometimes if you use not 30 but 100 stocks or 500 stocks, it can be really slow to calculate, and you need to optimize either to do it only for the new dates or to do it faster with vector calculations. The last thing for today is how we move from this merged data frame with text indicators to the final data frame, which includes all previous macro stats that we discussed previously. We started from stocksdf, we got mergedf with text indicators, we then add 16 additional data frames through joins. Final data set is about 289 megabytes and 203 fields. What you need to think about, you probably not in this case, but in all other cases when you have some scrape data, you need to control for duplicates. That's why I have validate many to one or one to one or one to many or many to many. So what does it mean many to one? That means that we can have many records from the left data set. Say we want to add S&P 500 growth for today for the existing data set, and we know that there are at least 33 records in that data set with for today's data, and one number from the macro stats needs to be applied to the 33 records on the left data set. That's why I have a validation many to one. Okay, let's check what we have in the code snippet. I won't go through all of the steps, but the idea is as following. We have mergedf with technical indicators, 144 columns, shape is 220k rows, 144 columns. We need to check that this number is not growing, that if you do joins incorrectly, it can be easily inflated, and then you'll have problems with the data consistency. I also need to convert date so that it doesn't have a local time zone, so that merge goes well. And I join with the first data set, which is a daily DAX growth stats, DAX index. Say for today, growth stats are like this, and it's not ideal because the trading day is not over, and you better run it when the market is closed, so that you get better results. But what we have here, after the merge operation, we join mergedf with tech indicators with DAX daily to merge. Left, this is a left data frame. We join on date. There is a field called date on the left data frame. We join on index in the right data frame. So here it is an index. If you have a field defined, which is called also date or some other field, you can write right underscore on, and we validate many to one. In the end, M2 is 150 columns, and you see that there are 6 additional columns defined. And what is good, that they are not none, they are filled, they are correct. Next steps are similar. We check the shape, 150 columns, 220k of records at S&P 500. Exactly the same merge operation, 156 columns, and new data should be defined, but it is not defined here because stock markets are not closed. We will see how to work on this. You need either to run later when the markets are closed and the data is there, or you need to backfill with the latest stats. And I would like to stress that the last data is the most important one, because when you train your model and when you want to put it into production and do some trading operations on it, you will update the last day stats, and you want that all data is defined properly so that you can make predictions on the stats, that your ML models work well. So we go through next steps, M3, M4, M5. They are all the same until you have some other data set. And in this case, after M5, we have GDP potential, which is a quarterly one. That's why I have to define another field in M5 in our current data frame, which is called quarter, and it is an extracted first day of a quarter. And now I can join not on the column date, but I can join on the column quarter. And as you can see, it is exactly the same date that you have here. This is again not ideal, because this information about growth of GDP potential, it won't appear immediately after the first day of the next quarter. So I should join it on some day which was later, only when the stats were announced. So that's what you see here. That's exactly the same data is propagated for two different days. You can see that we join on a quarter, and exactly the same stats are filled. Next, we join with the monthly data, and this is a CPI data. That's why I'm generating CPI months stats, and I join this time on a field months. So again, we don't have stats defined for the last months, and we need to backfill with the latest available. We will see this in a minute. Fields to fill. We noticed that these fields are nuns, and we can use the fact that Pandas knows that it's a time series, and it can fill with the latest available stats method ffill, and it will fill with the stats from the previous months. So now we have better data. We continue like this, Fed funds and rates, and so it's 16 steps. In the end, what you will have 220k entries, 202 fields. I define a prefix and I save this file to Parquet. I won't share this file with everyone, so that you can run through it, you can get this file and use for first analysis and for some home assignment tasks. If you see any problems with running code and obtaining this file, just write in Slack, and we will find some solution. Now, what we've learned during today's session. We started from web scraping data, how to process the data, how to define new fields. We discussed then time series processing and our daily stats. We added some new macro examples. we briefly touched on fundamental indicators, although I don't use them in this dataset. Next, we defined about 100 new technical indicators. I still think that you can be creative and define something that you can see from this time series, which will be your indicator. Or you can play with the different parameters of calling TI-lib libraries. For example, you can get a history of 14 days, of 7 days, of 20 days, of 50 days, and generate even more features. And as a result, we have this one data set that will be used for the next stages of our course. The homework is not published yet. I will have less questions. It will be one extra. I will still have one open-ended question, and the question will be about investing in IPOs. Say if you don't have any financial information or time series information from the markets, what data would you collect and what strategy would you want to have for investing in newly listed companies? Again, there are no correct answers. It's just for you to think about, to read and design your own strategy. The deadline will be the same, 1.5 weeks, approximately Monday in 2 weeks from now, or 1.5 weeks from this Friday. So the tasks are straightforward. There are no tricks. You will just need to check the code that is already published, slightly modified, and get your answers. As usual, you get extra points when posting homework, when posting public messages about your learning. And thanks everyone for today's lesson, and see you soon in 2 weeks.